So welcome everyone. Appreciate you guys being here, and we're excited to host David and Erica. I've known both of them for many years, and so appreciate you guys willing to come on and share some of your Monday evening with everyone. And Hayden, I'll turn it over to you.
Yeah, thanks, Dustin, and thank you everybody to spending your evening with us. We're really excited to have you here. We're really excited to hear from Erica and David about infinite banking and how real estate investors can use it to build and preserve wealth. So, really excited to have you guys here. And with that being said, I'll turn it over to you guys.
All right, thank you. So like they mentioned, my name is Erica. This is my business partner, David Wyatt. We are co-owners here at Infinity Investment Strategies. So we are going to look at today, how does infinite banking correlate? How does it tie into real estate, right? So we'll talk a little bit more about this later on, but the big thing is when we're working with people, there's people who know infinite banking, there's people who know real estate, but we really want to make sure that we bridge the gap between these two strategies to figure out how can these different aspects of our financial picture actually work in concert with one another. So one thing we want to start off with is we really want people to understand infinite banking concept. This is a strategy. This is an idea. This is an overall discipline in the way that we view money, understand money, and the way that we actually put it in play, right? This is we all call it the plug and play system. This is a way that we actually incorporate it into the rest of our financial picture. And I say that because this is not about, what we say like a financial tool, right? Like there are tools that we use for the job, but this is really understanding the strategy and how is this going to work in concert with all the other areas of our financial picture. This is not combative. We'll talk a little bit more about that here in a little bit, but infinite banking concept is where we're taking a specially designed cash value life policy and we're going to take advantage of the IRS code. It's written specifically for these types of assets, and we're going to take advantage of this code, get max benefits that we can, max protection that we can, and enhance the returns we're getting within real estate, and utilize these dollars in multiple areas. Like Robert Kiyosaki talks about putting $1 to work in multiple places. So we're going to go ahead and get into it. The number one thing when we talk about this, it's been called infinite banking, bank on yourself, be your own banker across the board. When we're looking at this, the big question is, well, why do we want to be a bank so bad? Well, think about it. When we look at how banks make money, we can understand how they have become the most profitable industry in the entire world, right? More than pharmaceuticals, more than oil and gas. This is the most profitable industry, okay? And let's look at this. So let's say, Dustin, you come to me and deposit money in the bank, right? And I'm going to pay you 0.02%, virtually nothing. But later on, when Hayden comes in to get a loan, I'm going to loan it to him at 6%. If we look at this from a mathematical standpoint, most people see, oh, well, the bank charged 6% and paid 0.02%. So they made a 5.98% return on that transaction. But here's the thing. This is where we start to have the mind shift. And this is what we tell people. 5.98 is only the spread. There is a big difference between money and math. And part of understanding this strategy is having this mind shift in the way that we view and understand the way money works. So when we're looking at how banks make money, we need to look at this like an investment. So what I did was every $100 that Dustin deposited, I invested 2 pennies in him. And I used Dustin's money to turn around and loan it to Hayden. So when I loaned that $100 to Hayden, I made $6. In any other investment transaction, that rate of return is a 300x. A 300 multiplier is what I have been able to do. That's what I've been able to create as a banker. So what they've done is, right, they're using number one OPM, but they've understood and they've taken advantage of this little thing called arbitrage. And this is what we're going to look at. How, and this isn't to demonize banks, right? But it's kind of funny. This is the same industry we've had about bailout twice in the last decade. But the point is, if we can say, hey, instead of putting all of our money in a bank to allow them to go out and recreate this process, why don't we just recapture more money in our own account so we can create this arbitrage for ourselves? So this is where we're talking about, hey, well, we need to understand there are different functions of money. There are different reasons and different ways that money needs to be put into play. So again, David and I come from the traditional financial planning back world, but what's funny is that industry is very much a my daddy can beat up your daddy type space, right? Like everybody's better than the other guy. But what we need to understand is there is no such thing as a good tool or a bad tool. There are only tools that are used for certain jobs. So what we need to figure out is, well, what are we trying to accomplish? What job are we trying to perform here? And that's going to dictate what tool we use. So with money, we have short-term, intermediate term, and long-term functions that we're trying to perform. So obviously short-term, that's pretty self-explanatory, right? That's going to be our bank account. So this is money that we know needs to be safe. When I go get it, it needs to be there, and it needs to be relatively liquid, right? This is money I need to have access to pay bills, do this, do that. The catch is, though, are we really going to get any growth out of a bank account? No, and that's not what it's for, right? That's okay. That's just part of it. This is money we need to use within the next 12 months. Otherwise, we're losing money due to inflation, and a lot right now, okay? Now, on the long-term side, this is going to be our investment category. So this is a very broad very broad category, because this could include real estate, business, stock portfolios, 401ks, whatever. Something that over the next 10 years, 7 to 10 years or so, we are wanting to see hopefully some level of growth. Can we guarantee it? No. All investments carry risk, so there is a risk factor. And we also know that money in an investment is not liquid. This is not something I can get to like that. So here's what we see as the savings dilemma. If you want safety and liquidity, you have to sacrifice growth. And if you want growth, you have to sacrifice safety and liquidity. So you're kind of darned if you do, darned if you don't, right? Especially people in real estate. I can't tell you how many people David and I have talked to. They're like, oh yeah, well, I want to invest in this deal, but I don't have anywhere to execute my money right now. I don't have anywhere to put it. It's all sitting in the bank and I'm losing money due to inflation. We have this gap here. We need to figure out, well, how do we bridge the gap between our bank account and our long-term investments? Again, not saying one is better than the other, but how do we fulfill all of the jobs that are not being done so far? All right, so I want to give myself guaranteed growth, a lot more than what I'm getting in a bank account, right? I need my money to be safe. So when I have a deal, I know that it's there. I'm not worried about it being tied to the market. I want to make sure that it's liquid, right? It's my money and I want it now. I always think about the J.G. Wentworth commercials, right? We don't have to want to jump through hoops or pay taxes or penalties just to get our dollars. Now, speaking of taxes, these dollars are tax-free. We're going to hone on that here in just a minute. And then lastly, these dollars are private and protected from creditors and predators. So all of these characteristics, this is why Warren Buffett has actually coined the term the vault. So think of a vault in your garage or basement, right? You can put money in when you want, you can take money out when you want. And who knows how much cash you have sitting in your safe or your vault at home? Just you, right? This is just your account, you don't need to open that up to anybody else. So again, none of these are better than the other. This is like having a hammer, a saw, and a screwdriver. These are all different tools that are designed for different jobs. So the question is, all right, well, we've got all these tools. How do we make this a cash flow synergistic system? Good question. I'm glad you asked. So how this works is you're going to take money out of your bank account and use it to fund your vault. Once it's in your vault, right, your policy, you're building up a cash value. You use your cash value to then go and invest in real estate or whatever else you want. You're going to pay that vault. You're going to pay your cash value loan back through your investments. We do have an example. And because of the arbitrage, guess what? Now you have more cash flow to go into your bank account. But guess what? Now you have too much money in your bank account and you need to put more money into your vault so you can do more investing and rinse and repeat the process. So over and over and over, we have this cycle of dollars that are going in and out, in and out. And yes, there is some subliminal messaging here. That is what we do. We help people create these synergistic systems that allow their money to, Robert Kiyosaki talks about the velocity of money. I like to call that the flow and grow, where our money is consistently earning and gaining compound interest and working for us, and we don't ever have to worry about that opportunity cost. So as we look at this, we're going to look at, okay, safety, liquidity, guaranteed growth, tax-free, and private, right? We will hone in on that here shortly. But what we need to understand about infinite banking is, how is this going to play a role in your overall picture if you were to plug and play this into your life, into your financial picture? And there's 4 different elements that we'll take a look at. The first one's going to be lower taxes. Now, I come from the retirement pension planning world. I'll tell y'all, I saw more people paying more taxes in retirement than they ever did while they were working, because they defer. So we need to be aware of that. And that's something where when we're talking about taxes, we bring up the self-directed IRA. Again, there's no good or bad tool. There are just tools. But these are some of the hurdles that we've had our clients bring to our attention, saying, hey, these are some struggles and some frustrations that I'm having. Obviously, with an IRA, no depreciation. That's a kick in the gut, right? Like no bonus depreciation, no cost segregation, man. That's one of the best reasons to get into real estate. We're also deferring taxes, meaning we're going to pay more taxes later. What are tax brackets going to be in 20 or 30 years? Probably not lower than they are now, right? Especially if we are planning on increasing our income. So we're setting ourselves up to have a taxable income source later on. We're also subject to UBIT, and anything left behind after the fact is going to be taxed on the next generation. So again, how do we solve these problems? Well, when we're looking through the lens of using an infinite banking policy, when you invest in real estate or business, you absolutely get to take any and all depreciation deductions. All of it gets to be taken upfront, lowering your tax liability today. You're also able to get additional deductions because when we look at this loan strategy here in a little bit, everybody knows there's that simple interest that's attached to your loan, right? That's part of it. That interest through your loan is an additional tax deduction. It is an additional write-off that lowers your tax liability today. You're also able, whenever you're borrowing against your cash, you're going to put your money in, it's going to grow, it's going to earn compound interest and dividends. All of that money that's in your policy, you get to use completely tax-free for the loan strategy. So while you're building, while you're accumulating, tax-free. Now, later on, we're all going to get to a point where we just want to sit back and collect that mailbox money, right? We're going to be sitting on a beach drinking mimosas. At that point, you get to flip the switch and say, hey, David and Erica, I don't want to put any more money into this. I want it to pay me. Cool. We'll flip the switch and it will spit out a tax-free guaranteed income to you for the rest of your life. Uncorrelated to the market, guaranteed. There's also no UBIT. There's no tax filing of any kind because remember, it's private. And then lastly, we have a tax-free generational wealth. So this is the most efficient way to transfer taxes from one generation to the next. No inheritance, no estate, no probate, nothing, right? In fact, they wrote a book about it called What Would the Rockefellers Do, right? You want to talk about generational wealth. Those guys know what they're doing. So again, everyone's a little bit different on the legacy piece, but we want to have tax deductions up front. We want to have a tax-free income later, and we want to have tax-free transfer of wealth later on. Moving on, increased control. So at this point, everyone's like, you know what, Erica, this sounds all cool and dandy, but how easy can I get my money, right? Like how accessible is this? Here's the thing. You get to borrow and lend on your terms. You are the banker and the borrower. You have become your own banker, which means you get to dictate the terms at which you are paying back the loan. Now, the company does set the simple interest rate. Okay, they're setting the interest rate, but you get to dictate how fast you pay that back if you pay that back. So if you had distributions that got stopped in 2020 because we had the eviction moratoriums and no cash flow was going, guess what? You don't have to pay your loan back until cash flow starts back up, right? We had a developer who took out a loan. He was building out a whole neighborhood, planned on it taking about 12 to 18 months. This took almost, what was over 2 years, almost 3 years it took. But he did not have to make a single policy payment, policy loan payment the entire time. No penalties, no ugly letters. He just had control over that completely. Now, the total cash value, whatever is in your cash value, that is what you have access to. I emphasize this because I have people argue all the time saying, oh, well, you only get to access like 60% of your cash. Forget that. Why would we do it in the first place? Whatever your cash value is, that's what you have access to. David and I do not play games with any of these companies that have surrender charges or vesting periods, okay? Whatever your cash is, you have access to it. You also get to use the cash value as liquidity towards your net worth on your PFS. So if you're going to a lender and you want to show how much cash you have, you get to use 100% of the value in your cash towards your PFS. This is true diversification, meaning it's completely uncorrelated to the market. It's flexible on your savings. So again, the first question is how easy is it to get cash? It's a phone call. Number two, how much do I have to put in this? Well, that's like asking how much does a house cost, right? You can, what is it David says? You can go buy a dilapidated trailer. You can go buy a mansion. It's completely up to you. So we work with each individual person and say, hey, what are your savings goals? And we're going to help you say, all right, this is how we're going to structure your policy depending on each individual person's situation. How much cash do you want now? How much cash do you want later? And we're going to tweak that. We also design every policy to build and grow with you over time. That's what we tell people. Start where you know you're comfortable, because these policies can and will expand and get larger with you as you and your business continue to grow. Now, on the last piece, speaking of your business, these policies have guaranteed projections plus reliable dividends. here's the thing, when we're looking at what our business is going to be able to do over the next 5, 10, 20 years, whatever it might look like, these policies are fantastic ledgers because they're guaranteed, and their dividends, although dividends aren't guaranteed, the companies we use have paid them every single year since their inception, 1848, 1872, a really long time. So over 150 years of dividends, and I personally am a skeptic. I actually pulled the dividend history for the last 50 years, and I looked and I saw every single year for the last 50 years, these guys have either met or exceeded their projected dividends, except for 2. And the 2 years they missed it by 0.5%. So my point to that is, when we go through these numbers with people, we're not just throwing stuff at the wall to see what sticks. We're going through realistic projections so you know how to plan ahead on what your business can look like. Now, on the risk factor, here's the thing. Most people think about the market, right? Obviously, that's a concern, but these are uncorrelated, guaranteed to grow every single year. So when the prices drop and when the market's down, guess what? You're going to be in a position of power. You're protected from the creditors and IRS, right? Now, state to state rules vary, so we'll touch base with each individual person depending on where you are. We're here in Texas, but most states allow you to protect your cash value from creditors, IRS, if you have a financial hardship. If you have a tax lien, we have 87,000 new IRS agents coming, guys. So if there is some sort of accounting mistake, or if there's a hold or freeze of assets for a little while, guess what? They can come after bank accounts, they can come after payroll, they can come after anything, but they cannot touch the cash value inside of your IBC policy. It's completely protected. Predators, this is a sue happy world. We know this, right? Like that's just what we're all facing. So when we're looking at this, we're saying, okay, it could be a disgruntled investor. It could be a clumsy tenant. God forbid it be, somebody break the bad boy rule. Here's the thing, LLCs can be broken through like that. We want to create as many barriers of protection for ourselves, for our family, for our assets. And these policies are just one more firewall to break down. It could be something completely outside of business, right? So like I said, we're in Texas and DFW. Y'all know the traffic here. If you've been here, I could rear end somebody and their neck hurt a little bit too much, right? They come after me, my house, my car, my dog. Again, they cannot touch the assets inside of my IBC policy. Here we go. And then lastly is a run on the banks. Again, at the end of the day, banks have 0 to no reserves, and they get to tighten up and loosen up on credit expansion when they feel like it. I'll tell you what, 2020 hit. We have a guy out in North Carolina. He owns 120 units outright. Didn't syndicate it. He just owns it. He went to the bank in April or May during COVID, and he needed some liquidity to help his property and help his business kind of manage through that time. He had over $1 million in equity in his home, went to the bank, wanted to get a HELOC. The bank told him no. Wouldn't do it. Said, nah, we're not comfortable with that right now. So do we really own something if we have to go ask permission to use it? Right? So again, these policies, you have access to your cash without regard, right? So we're going to move on. Let's talk about this leverage piece. So if we're looking at an IRA or a basic bank account, if you have 100,000 and you want to take out 70, I think I have the words in here. If you have 100,000 and you want to take out 70,000, you're only going to be earning interest at the 30,000 left over. That's very traditional. But as an IBC banker, if you have 100,000 and you want to take out 70, you're going to borrow against your cash value. That's the terminology. Borrow against your cash value. There's a simple interest rate attached to that loan, and you go out and you go on with your bad self, right? You can go invest in whatever you want and get your rate of return, multifamily, single family, Bitcoin, vehicles, finance, whatever you want. Everything outside of your policy, this is your rate of return asset. Please notice, not one time in this entire conversation have I talked about IBC being a great rate of return or accumulation tool. If you're coming at this saying, hey, this is my investment, no, sir, you're wrong. The investment's on the right box. This is your bank. Everything outside of that is an investment. Now, if you're getting cash flow from a property or from an investment, right now, you're probably taking that cash flow, putting it into the bank so you can use it again, right? Sure. The same system applies, except whenever you get cash flow, you put it back into your IBC bank, but the entire time that it's been out working for you, you've been earning compounded interest on the full 100,000. So again, this is where Robert Kiyosaki is talking about giving $1 multiple jobs. And this is where we're looking at understanding what Albert Einstein calls the 8th wonder of the world. Okay, those who understand it, earn it. Those who don't, pay it. What do y'all think he's talking about? Compound interest. And we know the compound interest curve starts off slow and ticks up over time. The problem is that most of us face oh, I need to use my money for an investment. I need to take it out and go out, put it elsewhere. And then you restart your curve until you need to use your money again. All right. And then your curve, what? It restarts over and over. So at the end, this is where we end up. This is where we could be. Now, are we going to be successful doing that? Absolutely. But what we have to understand is there is a gap between what we have and what we could have had. And that gap represents the most expensive and the most precious resource of all, time. We can never get that time back. So what we're saying is what infinite banking allows us to do is recapture that interest, recapture that time, and never lose it in the first place. So we are able to take money out of our policy, put it back in to a point where we never, ever, ever get off our compound interest curve. We maintain interest the entire time while still being able to go out and invest in anything that we want. So that allows us to, again, maintain the compound interest curve, never give up a single day, a single day or a single month of interest. And this is where we need to understand, okay, well, now that we know what infinite banking is about, we're going to look at how do we look at this tool and figure out what type of tool are we going to use for this. So just so you guys know, we are only using A-rated, mutually owned companies because of the way that these policies are designed. And the first thing we want to understand is we have a guaranteed base premium. Again, you get to pick this. It's completely guaranteed. But the death benefit, again, some people want a little, some people want a lot. Doesn't matter. We're going to customize it. It's going to grow over time. Your cash value is guaranteed to grow over time. And then you have dividends that get piled on top of your cash value over time. Okay, so this is just a general high-level overview of how these policies work. They are guaranteed. The only part about this that's not guaranteed are the dividends. But again, we're using A-rated companies that have been around for over 150 years, and they're mutually owned, which means not me, not you, not Dustin or Hayden or anybody else can buy stock in these companies. So they don't have an 8-figure CEO and they don't have stockholders to impress. So who do you think they pay those dividends to? You, their policyholder. So I'm going to transition to David. He's going to finish it up and talk about, all right, well, how do we design these things correctly? And how do we actually utilize them in a multifamily example?
Thanks, Erica, for that. Wow, great information in a short amount of time. And I don't think I can talk that fast, but I will certainly try.
Don't show this video to Meryl.
Good stuff. So, pertaining to this right here, I do want to point out, I think the last part of this slide is that as all of these are accumulating, you're going to have access, as Erica said, to 100% of that cash value. There is that one, that's right. There is one other aspect in this, right? So you have the guaranteed portion of the cash that begins to grow. And as you can see, that green line, it's a little slower because it takes a little bit of while to pay for the insurance part. And then after a couple of years, you start to really partake in the dividend portion. Again, as the insurance part's paid, the company starts to now take profitability and give it back to you in the form of a dividend. And then the key to really overfunding these and making these centered around a banking system is the ability to stuff cash in. And this is the IRS guideline around what they call paid up additions. So we can put in a bulk of our cash. It buys a little bit more of paid up additional death benefit to keep it a legacy product, but the 99% of that cash goes right into our cash value. And as that begins to accumulate and everything begins to accumulate, we have access to 100% of that cash. Do you want to keep moving forward on that slide, Erica? All right. So yeah, so as that accumulates, you have access to 100%. We'll move on to the next one. So what this does, though, is this gives us a lot of flexibility. And I think people have a misunderstanding on the flexibility of the funding levels on this. So when Erica mentioned, how much does this cost, right? And I always relate it to buying a house. How much house do you want to buy? Same thing with these policies. Everybody has a different budget. Some people have more zeros than others, right? But when we establish a base amount that is our base premium, that's going to be our minimum to keep the policy in force. And then with Erica and I's knowledge on understanding the design and the IRS guidelines, we're going to be able to create a maximum of cash that you can put in, all within the IRS guidelines, while keeping the tax benefits intact, because that's very important. We want to keep the tax benefits intact. In fact, you're able to dump as much cash as you want into these. There are some state planning and some other things that you can put unlimited amounts of cash in, but the IRS then treats it as a taxable account past certain limits. So we design it all within that ability to keep the tax benefits, but get max cash. So you can put in anywhere from the minimum up to the maximum or anywhere in between. Okay. And there are some aspects around, if you don't put in the maximum 1 year, you can go back and backfill a previous year. We can get into that specifics when we look at more of like a tailored one-on-one process that we do with people, but there's a lot of flexibility in how we fund these. So traditional life insurance bills. So, you know, a lot of people poo-poo life insurance. I was one of them. I used to poo-poo whole life. I was in the Wall Street world. I was a stockbroker, an advanced derivatives trader, and I was a buy term and invest a difference guy. So I used to say, whole life, you know, that's gross. Why would you do that? Well, that was through my lack of understanding of how that tool would be used, right? So this right here in a traditional life insurance build, this is like a hammer. And a hammer is not a bad tool, right? But if you're trying to bank on your account, you might need to cut a piece of wood in half. So you're going to need a saw, right? You can use that hammer and break that wood in half, but you're not going to have an easy time doing it. It's not going to be a smooth, smooth transition into breaking that piece of wood with the hammer, right? So we need a saw. But I do want to highlight this real quick on what traditional life insurance, how it kind of functions and what it might be used for, because this is important to understand. So the next time you hear somebody poo-poo in whole life, you can say, well, wait a minute, how are they using it? Is it in the right context? Are they using it the right way? Because it's not a bad tool. So traditional life insurance bill, let's take $100,000 as a minimum to fund into an insurance policy. Don't get caught up on the 100,000. This could be 10, this could be a million, this could be 20, 25, 37, right? It's just, we use this 100 because it is an easy way to look at the amount that you fund and how we would design it in a specially designed policy. So with this 100,000, with a traditional life insurance build, all that 100,000 is going to be directed into base. So what that means is that because of the insurance cost, year 1 and year 2 are not going to have much cash. And then it begins to earn cash over year 3 and on. All right. And what that does is it just takes a while to accumulate. Traditional life insurance builds with no additional cash dump-ins through the paid up addition rider break even around year 11 or 12. Okay. That means that break even in year 12, there is $1.2 million of cash available in this account. And then year 13 might be putting in 100,000 and it's earning 140, 150. It's really accelerating on past that. Okay. This is a great long-term play, but the upfront cash value lag really hinders it for infinite banking. Real quick, what is this used for? This could be used for buy-sell agreements, key man insurance, corporate insurance, a lot different things like that. But I do want to highlight a strategy where this might come into play. Let's say a traditional life insurance or a traditional investor is investing into a 401k and they are putting money into their 401k and getting their match, right? While they're working, when they log into their 401k and they see that it's red because the market is down, right? Market goes up and down. That's called sequence of returns. It doesn't really matter to them in the sense of affecting their everyday life. They might look at it and be like, ouch, that's terrible. But does it affect their ability to buy food and pay rent or mortgage, right? It does not. But when they go to retire, now their relationship with their 401k takes a 180-degree turn because no longer are they feeding it, they need it to feed them. So when they log in and they see that it's red, right, and they've just taken income, that's going to affect their ability to pull income. Maybe next year they got to take less income, right? So this can be used as a volatility buffer for somebody to fund alongside their 401k, make it a long-term play so that when they go to retire and they pull money out of their market and the market is down, right, because they're now subject to sequence of returns risk, they can give their 401k a rest and go and pull money, tax-free money from this bucket right here that's uncorrelated, meaning the market's down, whole life insurance is still earning a return. Right? So they can use this as a volatility buffer for income, giving more longevity to their 401k and giving them higher rates of return of income, higher rates of income more consistently. Okay, just keep that in mind. All right, moving on to specially designed life insurance policies. Okay, so what we're going to do is we're going to take this asset, we're going to design it all within the IRS guidelines, making it around cash heavy policy. So on the same 100,000, let's split that between the base and PUA. Remember, this 100,000 is whatever somebody's budget is. It's all finite, right? Eric and I are going to take this and split it between the base and PUA and find that perfect kind of ratio, right? And in this scenario, it's 20,000 base, 80,000 PUA. That means it's usually 3 to 4 times whatever the base is you can put in cash. So that's equivalent to whatever number you have in your head that you want to fund into this, 20% to 30% is going to be the minimum. 70 to 80% will be the additional cash that's optional that will allow you to overfund. Okay. So what we do though, is when this happens is that PUA is now going into cash right away. Right. And then over time, the base might start earning in year 2 and then in year 3. So it's accelerating the compounded cash value. We're not getting rid of cost. We're not finding free money because year 1, we put 100,000. We only have access to 80,000, but you'll have access to that as soon as the policy is created and in force, right? So now what we've done by accelerating the cash value is we've gotten rid of that growth lag so that day 1, we can now go and invest in real estate, business, right? We can start that banking process. Go ahead and move forward on the next one. There you go. So we can go and invest in real estate, investment, business by borrowing against our policy, go and make a rate of return and keep the earnings inside the policy intact, okay? So the key to this really is we're giving it functionality of short term. We're keeping the long term, right? It can still function as key man, buy, sell, a volatility buffer against market, real estate cash flow, right? We've seen real estate cash flow stop at times. If that stops and we're relying on that, we might have another bucket of income to buffer against that real estate income, right? So we've given it cash value in earlier years. We've also minimized the break-even point. Now the illustration shows the break-even point at year 5.5, okay? Because we've accelerated with cash. Now that's not taking into account the rate of return ability of borrowing against your cash to go and invest, okay? So that's a little bit more on a one-on-one where we can really analyze kind of a tailored aspect of how that would play out in your situation. So moving on. All right, so this next slide, I like to point this out because a lot of people invest, but they also have businesses. Now we have a whole other presentation that we go through with business owners about this, but I like to point this out because if you own a business or if you have investors that own a business and you syndicate and you're a money raiser, capital raiser, you can offer this kind of scenario or look, have them look into this strategy and really help their business. So you have XYZ company, right? Has January through December. And they have goals, right? They have their profit minus taxes, their residual, right? And they're getting sales revenue through accounts receivable. And those are seasonal, right? Sales revenue is seasonal, right? And then XYZ also has payroll, rent, and other, okay? This is kind of their cash flow. Most of the time they have a credit line of 90 days, right? And usually XYZ has accounts payable to a supplier company, okay? So supplier company gives them credit for merchandise. Now, who else is in the mix here? The commercial bank. The commercial bank is the other entity involved in this transaction, okay? So if you think about it, right, XYZ's money from sales revenue is getting deposited into the commercial bank. And the commercial bank also dictates the lines. Go ahead and move that one forward, Erica. So as they're depositing their money into commercial bank, the commercial bank is dictating the lines of credit and the note terms, okay? All the while, the commercial bank is having liens on all of the property, right? Has liens on all of the labor, the capital equipment, everything. And in bankruptcy, commercial bank is the only one that's a secure creditor. So I'm going to pause for just a minute, right? And just kind of, how did we get here? How did we get to a point where XYZ and supplier company, you and I, are doing all the work, putting and having all of the risk, and all commercial bank is doing is taking your money, loaning it out to me, and giving you nothing for it, charging me, and doing vice versa. And when it fails, or not when it, if it fails, hopefully it doesn't fail, right? If it fails, we're both SOL, but the bank wins. The bank always wins. This is why we want to emulate a bank, okay? So XYZ company could actually very greatly benefit from bypassing at least a portion of their banking system to create an alt bank, okay? Go ahead and move that forward, yeah. And through that, they can have tax benefits, right? They have flexible loan terms. They can reuse this as a buy, sell, key man insurance, all of that, right? So a very, very good strategy for business owners, right? Now, last thing I'll say on this slide is a lot of people say, hey, I put my money in a bank because it's safe, right? We feel all warm inside that we got our money there and it's protected and safe. It's better than being in the mattress, right? Well, if you think about FDIC and federally insured money and the reserve, right, is $88 billion in reserve right now accessible, right? That seems like a lot until we realize that the total insured US deposits is $7.1 trillion. So that's a little over 1% of our ones and zeros on this screen that we log into and look at is actually available to access. Now, we're so far removed from a bank run, we tend to not even think about it. And hopefully it never happens again. But to think that it could not happen is a little naive. We've seen Greece, we've seen, Venezuela, we've seen other areas that have had these banking issues. And you guys have kind of seen some of these issues. We all have that feeling down that things are a little uneasy. So how secure are you if there is a bank run that you would be the little over 1% that would be able to access their money? I'm not very secure in that. Now, I can log into every single one of my cash value policies and know that if I went to go withdraw that money and everybody else in that insurance company went to go withdraw their money, it is available to them. The insurance company guaranteed cash value is 100% accessible to everyone. Okay, just kind of a protection piece there. Moving on. So little disclaimer, this is just a hypothetical representation of an investment using infinite banking. There's a lot of other facets and different kind of variables, right? What kind of earning rate of return are you getting outside the policy? How much are you actually overfunding the policy, right? What company are you using? Is it designed right, designed by us, right? So there's a lot of other facets on that. But moving forward, we're gonna show you an example. Kind of this is that kind of hypothetical example of investing in a multifamily deal specifically. Now this works for many types of investments, but let's do this. Let's clone every single body on this call. In fact, just talking individually, clone yourself. Okay, all things are the same except for one thing. So your liquidity, your starting liquidity is the same, and your investments that you go and invest in forward are going to be the same. The only difference is your clone says, no, I don't want to do infinite banking. I'm just going to keep taking my money and going into cash. I don't want to pay for an insurance product. Okay. You, on the other hand, you see the benefits, the asset protection, all of the, the forest through the trees, all the future benefits, right? So you're going to do infinite banking. I like to use analogies. So let's equate it to the tortoise and the hare race. Okay. Let's make it a liquidity race. Who wins with liquidity in the end? Your clone is going to be the hare in the liquidity race, and you're going to be the tortoise in that race. What happens? Tortoise gets off to a slower start, right? Hare falls asleep, tortoise ends up passing him and winning the race. And we know the adage, it's not how you start the race, it's how you finish. Well, why am I relating it to that? Because the tortoise, or you doing infinite banking, is going to have some money upfront diverted for paying for a legacy product. But after a while of keeping that future value intact, creating arbitrage, you are now going to surpass, you're going to make up for that acquisition cost plus some, and then you're going to get to a point where you pass your clone. This is kind of that hypothetical example in that liquidity race where remember, you're investing in the same things, but you are able to earn more money with the way that you invest. So let's take a $100,000 example, $100,000 investment into a 5-year deal. We're going to keep it very, very simple. We're going to look at not a fluctuating cash flow, just a static cash flow, so we can keep things easy. We know it fluctuates, but it would be the same for both of you. So it's all going to equal out, right? And we're not going to look at reinvesting that cash. Let's look at just this deal. So at 8% cash on cash, pop in year 5. So your clone has $100,000 in the Wells Fargo account. If he or she wires that out to the bank or to the LLC, they have $0 in that bank because we're just looking at that investment. And I think if you move forward, it'll erase that one, Erica. There you go. So it erases that one. So as cash flow, go ahead and move forward. As cash flow comes in, you're going to have 8,000, 24, 32, 40,000 in cash flow. Property sells out. Let's say there's a pop of 50,000. End of the year, you have $190,000, right? The increased value plus cash flow. So a 1.9x multiplier, right? Pretty similar to a lot of deals. Again, a lot of caveats and facets, but we're just looking at a simple investment here. Okay. So he's pretty happy. She's pretty happy, ready to go to a new deal. Now let's look at infinite banking. So you have 100,000, but you're going to use IBC. Go ahead and move the slide forward. I guess I'm getting a little bit of delay. I'm not seeing it move forward, Erica.
I have it on the IBC real estate investment.
Yeah, keep going. Go one more. IBC. All right. So you're going to call the insurance company because you have 100,000, but you have 100,000 in your cash value. Okay. So you're going to call them up and say, I want to loan against that cash value. They're going to loan you their money and leave your money growing. They're going to charge you a simple annual interest rate, but let your policy grow and earn the guaranteed and dividend rate. Okay. So in this example, they're going to charge you 4.75 simple. So let's just park your 100,000 in cash value for 5 years. Let's forget about it for 5. Let's just look at the loan balance with the cash value. Okay. So I'll just briefly explain how this happens because I think it's valuable that you know. Usually the insurance company is going to pay you roughly about 4% guaranteed. The dividend is where the policies earn maybe 6, 6.5, 7. Okay. Now the insurance company is not on the hook for the dividend. That's profitability. So when they charge you 4.75 simple, they just move over 4% into your policy, the guaranteed, pays for the guaranteed, and they pocket 0.75. Okay. Your arbitrage comes from the guaranteed plus the dividend. Okay. So we'll get into that more on a one-on-one level. But year one, $4,750, right? Because balance is 100,000 and it's a simple interest. Your $8,000 of cash flow is going to go back into your bank, right? It's just some of it is paying some of the interest, some of it is paying some of the principal down. So if you look at year 2 and remember this number, 96,750 is your balance. Okay. If you do the math, 4.75 is for the interest rate simple is 4,596. So what's happening is as you're paying down the loan, your cash flow or your interest being charged is going down. Go ahead and move forward. As you can see, right? The amount of interest being paid is going down as your balance goes down. This is important because you got to remember what's happening on the flip side as your money grows. Now we know that 40,000 is not going to pay off a $100,000 loan. Okay. So you have a balance of 82,131 at the end of 5 years, but you now have your 100,000 that you got paid from that you borrowed plus the 50,000. So you have 150 in your pocket. You're going to go ahead and pay the 82,131 and that's going to settle up the loan balance. So now you have zero loan balance against your cash. Now, mind you, you can borrow all along the way, the difference from your cash growth and your loan paying down. That gap, you can borrow that along the way. Same thing with your clone. As cash goes into the bank, they can now reuse that. Okay. I just want you to be aware of that. And we can get into that more specifics. But let's look. Your policy has now been earning about 6.6%. I took the top 5 mutually owned companies. Okay. And I basically took their total earnings with their guaranteed and their dividends, and it averaged about 6.6%. And we only use A-rated mutually owned companies that Infinite Banking works with. Okay. So if you're earning about 6.6, your cash value has earned 37,653 in this calculation. Okay. You also have 67,869 in your pocket, right? Because you have no loan against your cash. You check your cash balance and you can now borrow that 100% of the cash value. Plus you have money left over from paying off the loan. You can take the cash and borrow the cash value. You now have 205, 522. Where did that additional money come from? Well, look, what's happening. Compounded interest is going up as the balance goes up, right? So your arbitration is happening, your arbitration spread is growing each year. So if we move forward and look, you'll see where does that 15,000 come from? Year 1, okay, as you see in year 1, you earned 6,600. You paid, move this out of the way. There we go. You paid 4750. So your arbitrage was 1850, meaning you didn't just make 8,000 on the investment, you made 9,850. Well, how did that work, right? Well, think about this. In year 2, your cash balance was 106,600, but your balance on your loan was 96,750. Remember, I told you to remember that number. So you can loan, you can't loan 96,750, but you can loan up to 106,600. If you do the math, that gives you the availability of 9850 that you can go borrow. Okay. So year 2, you earned a little more, you paid a little less. Year 3, same thing. So your arbitrage is growing. So as your policy grows, so you can see in years 5 through 10, 10 through 15, right? The arbitration just begins to happen more and more and more. So the arbitration is cool, right? This is a neat way to earn additional cash on your investing. But let's go back to the real important thing. We're going to finish up here. So, and this is, and I can we've got 5 minutes and then we'll take some questions, but the arbitrage in the banking arbitrage is a really neat strategy. But when we talk about the financially mature and the financially elite people that have multiple policies and high net worth people, banking arbitrage is a neat way to earn towards a return, but it's not the main reason to use this strategy. Okay. We want to think like a forester. We want to see the forest through the trees. We want to be able to plant seeds now that we can harvest a lot down the road. Okay. So the ability, remember when Erica talks about this compound interest curve, right? And unaffecting that curve while utilizing our cash. Think about that penny doubling a day for a minute. Penny doubling a day, 2 cents, 4 cents, right? After a while, it becomes astronomical amounts. But when it hits in the hundreds or thousands and we have to go use it elsewhere and it starts over, it'll never reach those astronomical amounts, right? Same thing with our cash value. So if we just take that 100,000, I like to look at everything on a graph. So let's look at the earnings on that 100,000 and let's take it out to 20 years. In year one, it earned 6,600, okay? But in year 20, that same 100,000 is now 336. It earned 22,230 of interest because there's no new cash flow. Look at that annual cash flow column. We have nothing there right now. So it's just that 100,000 compounding. So in year 5, 137, I rinse and repeat. Year 10, I have 189, I rinse and repeat, right? Year 15, 260, I can go and borrow against that and know that my policy is going to get those types of growth unaffected. I'm going to continue to earn unaffected by the loan, right? So what if now, and then this is why I love putting money in my policy. I look forward to putting my money in a policy. Now, it's not my investment tool. I do short-term rentals. I do multifamily, new developments. I'm looking at storage units and mobile home parks now is next, right? So that's my investment outside, but I still look forward to funneling money into my policy, right? Because I can just access it to go and invest, but I know that I can control my compound interest curve by overfunding this policy. Some people will say, hey, do I have to fund this forever? No, you don't have to. You can set this to pay itself. But if you fully understood how this policy functions, you're going to want to feed it as much as you can. Because look at what happens if we just put in $10,000 into the cash value. What does it do to the compound growth? Year 1 doesn't do much. It went from 66 to 7.2. But in year 20, it went from 22,000 of earnings to 48,000 of earnings just for that 1 year. And I can access it all along the way. Year 5, instead of 137, I have 198, right? So that is the real kind of thought process and paradigm shift. This is why when you talk to a lot of people and they're like, and I've heard this a lot lately, and we'll finish up here. I know a lot of high net worth people that do this. Okay, let me kind of have you think about something. Did they get bamboozled by an insurance salesperson to get one of these? Right? I don't think so, right? And did they only do these policies because they were high net worth? Or are they a high net worth person because they have these types of open-minded strategy thinking, right? And are using different types of strategies, tax strategies, and understanding these products? I'm going to say in my 22 years of financial experience, it's the third option. They are where they are now because of understanding financial products, what their use are, and how to implement them into the best strategy of their plan. Okay. So we'll finish up there. I think, do we have a last slide? So
yeah, I think that's a really good feeder into this because at this point, right, one of the big questions we get is, David and Erica, this sounds great, but if it's so awesome, like, why isn't everybody doing it, right? And the big question is, well, who's your everybody, right? Who are you trying to emulate? Who are the people that we really want to look at their success and rinse and repeat that process for ourselves? So these are just a couple of examples that we have of how has infinite banking been used in different scenarios, just to kind of give some perspective on like, oh, this has been around. It is something I'm more familiar with than we even realize. So this is a picture of Rockefeller Center in New York. Fun fact, this is the largest privately funded construction project ever built. When the Great Depression hit, the banks wouldn't even give J.D. Rockefeller a loan. Like, that's how tight things were. Right. However, he wanted to build this. So he fully funded the entire construction of Rockefeller Center in New York City with only his cash value life policy. So think about that. It wasn't tied to the market, so it wasn't affected by the Great Depression. And he had no restrictions on the access to his cash. Same thing what happened to Walt Disney. He wanted to take out a loan to start a theme park. The bank told him no. Imagine being the banker that told Walt Disney no to start a theme park, right? Like, that guy messed up. Pampered chef in the 80s. Doris, she was a home ec teacher, wanted to start a cookware company. Couldn't get a loan, used your IBC policy. Foster Farms, there's a family out in California that's the largest chicken producer in the state. We have politicians all the time. Joe Biden, Donald Trump, John McCain, the Roosevelts, the Kennedys, across the board, we see these guys use it all the time to fund their campaigns and for their personal investments. So here's the thing, guys, if Republicans and Democrats can agree on something, you know it's got to be pretty good, right? Like point blank.
And one point I'll make after that too, right, is who changes regulations?
Yeah.
Both of them, right? So if they're using this policy, they're using those, we don't hear a lot of regulations changed for these things, right?
That's
so
a very good point.
We want to emulate some of the things they're doing in that sense. So
the very last one, if you guys get a chance, I recommend that you look up BOLI-COLI. This stands for bank-owned corporate-owned life insurance. The largest banks and corporations in the world hold a majority of their assets inside of these types of policies, right? Bank of America, Wells Fargo, right? All of these guys hold their cash inside of a BOLI. JCPenney used their corporate-owned life insurance policy to pay every single JCPenney employee throughout the entire Great Depression. So again, it wasn't affected by the market. They had complete access to that account, and they knew they didn't have to pay that loan back until they were able to weather that storm and pay it back right when they were ready. So these are just some really good examples of that. Oh, it's all in there. So at the end of the day, we'll go ahead and start taking questions. Again, we've already kind of talked about this a little bit. Two key things I want to point out. Number one, David and I are authorized infinite banking practitioners. We've gone through the course, we've gotten the certification and the license. We are also on an independent platform and work specifically with real estate investors and business owners. So when people ask us like, hey, this is great, but why you guys? Again, there's people who know real estate, there's people who know infinite banking. David and I have created a specialty in marrying these two and making them work together.